Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at B2Gold.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, B2Gold. I feel like the story here really starts with their recent performance. Where do they stand right now financially?
Yeah, you have to start with Q3. The numbers are pretty incredible.
Let's hear them.
Gold revenue shot up to $472.6 million.
Okay, and what was it before? For context.
Well, the same quarter last year, it was $195 million.
Wow. Okay, so that's more than double. What drove that? Was it just the price of gold going up?
That's the key thing. It wasn't just price. Their production almost doubled. They pulled 146,883 ounces out of the ground.
That's a huge operational jump. But, is that just a one-off good quarter, or is this part of a trend?
It definitely looks like a trend. If you zoom out, the year-to-date revenue is already over $1 billion. And the trailing 12 months, the TTM, is at $2.51 billion. And that's coming from $1.74 billion in 2023 and just over $2 billion in 2024. So you can see that clear, steep climb.
It's accelerating. But revenue is one thing. You can sell a lot of gold and still not make money if it costs too much to get it.
Yeah.
What about their efficiency?
That's the other side of this coin, and it looks just as good. Gross margins are strong, around 46%.
And the actual cost per ounce?
The cash operating cost came in at just $780 per ounce produced.
$780, that's really low. And it was below what people were expecting, right?
Exactly. They got a bit of a boost from lower fuel costs, but also a weaker Namibian dollar helped keep local expenses down. They're just running a really tight ship.
So if Q3 was this strong, what's the outlook for the end of the year?
The projection is that Q4 is going to be even stronger.
Really? Why is that?
Two things. They're hitting a higher grade section of ore, which is just more gold per ton of rock. And the new Goose project is starting to ramp up, which will add to the total.
Okay, so the operational momentum is still building. But strong operations don't mean much if the company's finances are shaky. Let's talk about the balance sheet. Is it solid?
It's more than solid. For a mining company, it's exceptional. Their debt-to-equity ratio is between 0.18 and 0.19.
That is incredibly low for this industry. They're not over-leveraged at all.
Not even close. And they're sitting on $367 million in cash. Plus, their interest coverage is almost 19.
Meaning they can pay their debt interest bill 19 times over with their current earnings.
Yeah. It means they're safe. They have the flexibility to handle problems or jump on opportunities without running to the market for money.
And that financial strength really underpins their competitive advantage, right? This idea that they're a low-cost producer.
That's their moat. It's built on their top-tier assets, Fekola, Otjikoto, Masbate. But the number that really defines that moat isn't just the cash cost.
It's the all-in sustaining cost?
Yeah.
The AISC. What's that number?
It's $1,479 an ounce, and that number includes everything: maintenance, exploration, all the overhead to keep the mines running long-term.
And why is that the magic number?
Because it's their floor. If the price of gold tanks, a lot of companies with higher costs get crushed. They start losing money. But at $1,479, B2Gold can weather some pretty big storms and still be profitable. It makes them resilient.
And that resilience lets them do things like pay a dividend.
Yep. They pay a 2-cent quarterly dividend. It's about a 1.7% yield, so you get some income while you wait for that growth.
Okay, so the fundamentals look great. Resilient, growing, efficient. But is the market paying attention? What do the charts say?
The market is definitely waking up to this story. We saw that recent 5.7% price surge.
On huge volume, too, right? Over 38 million shares.
Exactly. High volume. That means conviction. It's not just noise. And technically, the stock just confirmed a golden cross.
Explain that for us.
It just means the price is now trading above both its 50-day and its 200-day moving averages. It's a classic signal that an uptrend is in place and has momentum.
And is there strength behind that move?
It looks like it. Indicators like the RSI and MACD are showing what we call a bullish divergence. Basically, the internal strength of the stock is building even faster than the price itself, which often happens before a bigger breakout.
Interesting. And what about volatility? Does this thing swing all over the place?
Actually, no. It's got a low beta, just 0.59. So it tends to be less volatile than the overall market, which is a nice stabilizing factor.
So it's not just retail traders jumping in. Are institutions buying?
Oh, yeah. You can see the cluster buying. Euro-Pacific Asset Management, for example, just added almost 600,000 shares to their position.
Mhm.
When the smart money starts accumulating like that, they're anticipating something.
So what are they anticipating? Looking ahead, what's the next big catalyst?
The immediate one is the Q4 results, which we'll see early next year.
And the expectation is a big beat.
Given the production forecast we just talked about, yes, a strong beat is what everyone's looking for. Beyond that, it's all about growth. The Goose project ramp up and, the fun part.
The discovery potential.
The discovery potential, there's always chatter about new finds. That keeps things exciting.
And all of this positions them perfectly for the bigger macro story for gold, doesn't it?
Absolutely. Because they're a low-cost producer, they have huge leverage to a rising gold price.
So when you hear those wild forecasts, gold going to $5,000 an ounce by 2026.
If that happens, a company with an AISC of $1,479, the cash flow becomes exponential. Their profit margin just explodes. That's the super cycle upside that institutions are positioning for right now.
Okay, this is an incredibly bullish picture. We have to poke some holes in it. What's the bear case? What could go wrong?
Right, and there is one. First, while we're bullish, Wall Street as a whole is kind of mixed, and the AI signals are pretty neutral midterm.
And what about the actual profits? We said gross margins are 46%, but the net profit margin's way lower, like 8.75%. Why the big gap?
CapEx, capital expenditures, they are spending a ton of money right now to build out their future.
How much are we talking?
The last outflow was around $172.8 million. It's a drag on short-term profits, no question. But it's that classic trade-off. Spend today for more production tomorrow.
And that spending leads to a higher valuation, right? The PE is up around 34, so maybe investors are already paying for that future growth.
That's a very fair point. That's a core part of the bear argument. But I think the biggest risk, the one that people sometimes overlook when they're just looking at spreadsheets, is geopolitical.
You mean where these amazing low-cost mines are located?
Exactly. The Fekola mine is in Mali. Otjikoto is in Namibia. These aren't the most stable regions in the world.
So sovereign risk. A change in government or mining laws could just wipe out that cost advantage overnight.
It's the wild card. The company has managed it brilliantly so far, but it's a risk that's always there. It's the trade-off you make for getting access to such rich, low-cost assets.
So tying it all together then, we have explosive growth, amazing cost control, a rock-solid balance sheet, and huge leverage to a potential gold boom, but with some real spending drag and geopolitical risk. What's the final takeaway?
I think this is a classic defensive growth opportunity.
Yeah.
You have the safety of the low-cost structure and strong balance sheet, but also the significant upside from the gold cycle.
So this isn't a short-term trade.
No, absolutely not. This is a multi-year hold. You're buying into the thesis that management can navigate the risks while these big growth projects come online and start spitting out cash, just in time for a potential peak in the gold market.
Absolutely. If you found this discussion helpful for your decision-making, make sure you hit that subscribe button to keep getting all the latest analysis from Smart Wealth with Joshua.